Hello, this is the part 3 of Douglas activity. We recently did the part 2. Now let's tackle the question 6. It says sold half of the goods on credit to Tish for $1,750. So the business sold half of the goods on credit to Tish. So let's now identify the accounts involved. So it says sold. Tish. So sold means like sales. So the sales. And now let's see who Tish is. They sold half of the goods on credit to Tish. So Douglas sold half of the goods to Tish on credit, meaning Tish didn't pay for it. So who is Tish? So Tish is a debtor. Tish bought the goods on credit, didn't pay for it, so it's a debtor or trade receivable. So now we've been able to identify the accounts involved. That the sales account, and who is a debtor. So Tish. Now let's look at the effect of this transaction. The effect, before we draw the account, let's look at, so it was sold half of the goods on credit to Tish. So sales, so let's look at the effect on each of the accounts. So let's take the sales account. So what happens? Does sales increase or decrease? The company sales increases, so sale increases. Because the business sold goods on credit to Tish, so the sales of the business has increased. And let's look at what happened to Tish, who is a debtor. So what happened to our debt? What happens to our debtor? Debt increases. Debt also increases. Now let's open the T account. So for Tish, Tish is a debtor. And debtor is an asset. It belongs to the business. The business has control over it. And what's the accounting rule for assets? We say assets increases at the debit side. And decreases at the credit side. And we know that the left side of the T account is the debit side. So here is the debit side, the left side. And the right side of the T account is the credit side. And we know asset per the accounting rules. We said asset increases at the debit side. And we've been able to identify that Tish is a debtor because Tish is a debtor. We sold on credit to Tish, so Tish do owe the business. And we said the effect is debtor increases. So we know that the asset increases. So we need to debit it. So it has to be at the left side. So we debit it to 1,750. In the name of sales, it was due to sales. So this is the effect. Now let's open a T account for sales as well. Let me see if we do have sales account somewhere. Okay, we don't have sales account, so let's open sales account. So let's state the accounting rules. We say sales increases at the credit side. And decreases at the debit side. So here, the left side of the sales account is the debit side, and the right side is the credit side. And it says the effect is sales increase. So sales increase. So we say the accounting rule says when sales increase, you credit sales. So we need to credit it by the amount, which is 1,750 in the name of Tish, who is a debtor. So in the name of Tish, who is a debtor. So that's it. We are done with question 6. Now let's go to question 7. It says due $300 for his own expenses. So Douglas drew $300 for his own expenses. So now let's try to identify the accounts involved. Due. So drawings. For his own expenses. So this is the keyword, for his own expenses, his own expenses. So I told you earlier that the business and the owner are two different entities. That they are not the same. So the owner drew $300 for his own expenses. It's drawings because the money the owner drew is for his own expenses, not for the business expenses. Assuming he drew the money for business expenses, then it wouldn't have been drawings. But he drew it for his own expenses. So it means the capital he has invested in the business will decrease because he has taken money from the capital he invested into the business. So let's open the drawings T account. So the drawings. So he withdrew money for his own expense and he withdrew from his capital. So what's the rules regarding capital? We said capital increases at the credit side and decreases at the debit side. And we know the left side of any T account is the debit side, and the right side of any T account is the credit side. So it says drew 300 for his own expense, and I said drew for his own expense means his drawings. He drew for his own expense. It's not for the business expense, for his own expense, so his drawings. And I said he drew it from the capital he has invested, so it means capital will decrease. Capital would decrease. And how do we treat capital when it decreases? We debit it. How do we treat capital when it decreases? Because he has withdrew money from the capital he had invested into the business, it means the capital will decrease. And we debit capital when it decreases. So we will debit it by 300, the amount he withdrew, $300. In the name of cash, he withdrew cash. He withdrew $300 for his own expenses. The amount he withdrew 300 cash. So it means the cash we have in the business is also going to decrease as well. So I think we have cash account somewhere. Yeah, cash account. It's also going to decrease. So it will decrease as a result of drawings. $300. So when we debited the drawings account, you realize we credited the cash account. So when you debit one account, you credit the other one. So first identify the accounts involved. It could be 2 or more accounts. Then when you debit one, you have to credit the other one. So the total balance of the debit side must be equal to the total balance of the credit side in the other account as well. Now let's look at the last question, question 8. Then we'll call it a day and continue with another topic. Question 8, it says sold goods for cash 2,100. So as always, let's identify the accounts involved. Sold good for cash. So it's which account is this transaction affecting? It will affect the sales account and it will affect the cash account as well. So the sales account, let's draw the, now let's take the accounting rules regarding sales. We said sales increases at the credit side and decreases at the debit side. So let's look at the effect this transaction has on sales. Say sold goods for cash, $2,100. So what happened? The sales of the business will increase or has increased. It's going to increase. And per the accounting rules, when sales increases, what do? When sales increases, we credit sales. Say sales increases at the debit side, so we credit sales. So we're going to credit the sales account because it has increased. The effect is we made sales, so the sales of the business is going to increase. And per the accounting rules, we say when sales increases, we credit it, or sales increases at the credit side. So we are going to credit sales 2,000 in the name of cash. It was due to a cash payment. That was why sales increased. So due to cash. So cash. And now we're going to look at the effect on cash. So we debited it in sales. So we credited sales. So we know that the next account involved has to be debited. Why are we debiting it? Because cash has increased. So let's go and look at the cash account, the effect on the cash account. It says sold goods for cash 2,100. So cash will increase because we made sales and the person paid us cash. So our cash is going to increase. And what does the accounting rule says? What does the accounting rules says about when an asset increases? It says asset increases at the debit side. So cash, which is an asset, has increased. Cash is an asset. It has increased. And it says when it increases, what do? We debit it. So we will debit it. We will debit the 2,100. And it increased due to sales. I hope it makes sense. If you have any questions, let me know. So we are done with all the questions.